Good afternoon, everybody, and welcome to the Thursday afternoon Independent Solutions Investment Committee call. I'm Glenn Wiggle. On today's call, we will have Mike Lomas again moderating the call. We have a full investment committee for you today as well. We've got CFA John Thur will be joining us. We've got Paul Meeks, also CFA. Danny Neiman, who's our Chief Investment Officer and Mutual Fund Manager, is also joining us as well. We've got Dave Mariacher, and finally we have Mike Zimmer. So I think I've got everybody. We'll have about a 15 to 20-minute call today, and obviously if additional questions, of course, go to our website at iswealthmanagement.com. Mike, you have the floor.
Perfect. Thanks. Well, since last Thursday when we all got together, the market's been up about 10%. The Saudis and Russians reach a deal on deep oil output cuts. The Treasury Secretary says U.S. could be open for business in May. The Fed announced $2.3 trillion in stimulus for business and municipalities. And Mr. Bernie Sanders dropped out of the presidential race. So with that, maybe I can start with Paul Meeks, one of the CFAs. Paul, how are you, sir? The economic data has been brutal at best, but the market is rallying. How could this possibly be?
Well, I think what happens, it's not necessarily draw a line in the sand for the number of coronavirus cases or even the number of coronavirus deaths, though we all hope that they moderate quickly. But it's when do we wrap our brains around the economic damage? And so that conclusion hopefully comes well before the actuality. And so I think some folks are believing, I don't know if it's actually correct, I actually would probably bet against, that we have a V-shaped recovery coming. And if we have a V-shaped recovery coming, why not get back to work now and buy some stocks? And so I think that's what's happening. What I'd like to see are a number of companies report their earnings, which will happen in about 1 to 2 weeks from now. And then at that point, if we get the Wall Street analysts following those updates, slashing their estimates to the floor, then I'm more comfortable that we have fully absorbed the potential damage of the coronavirus. And then if earnings estimates can no longer drop, they can only go up. And I think that's a safer time to invest, in a bigger way. Though I did invest in my tech strategy for the first time in a long time just yesterday.
All right, perfect. Mr. Thur, we'll switch to you, John Thur. The Fed announced $2.3 trillion in stimulus for businesses and municipalities. But it seems like now every week the Fed is announcing another $1 trillion package. What's the significance of this, the importance of this? What's the positive, what's the negative, and why'd they do that?
Well, the positive, Mike, is that it's going to really, I think, help mute the recession. I think the negatives are many, and I'll give you one. When you're bailing out companies now, and that's basically where they're headed, and the Fed has said they're now going to buy even high-yield junk debt in the marketplace. What they're trying to do is create a feeling of security amongst investors to say, we're not going to let this go down. Now, once again, here they are intervening, trying to take risk away in the market. This market is about risk. And I think intervening is only prolonging the inevitable. And I think it just creates more uncertainty for everybody. Like, when is the shoe going to drop? So, it's got its positives and its negatives. There's a cost to everything. But my big question is, when I hear these things, how are you going to pay for it? And I think we're getting that mentality. I hear a lot of people using hey, when I was a kid, I was told money didn't grow on trees. And they want to know if there's a money tree at the White House. So this is all got to be thought through, and understand that just because you're taking away risk, the current risk in the market of defaults or of companies going under, it doesn't mean it's gone away. It's just been transferred. So I think we got to understand that.
Yeah, we talked a little bit last week. Some of this stuff can be kicked down the road, though, for a long time, right? I mean, that's the risk of trading or trying to time markets is, they could put a Band-Aid on this, but unlike in your personal life, that Band-Aid could be a big Band-Aid, right? It could last for 10 years, 20 years. You just don't know.
Well, I think we've been into it now 12 years, and this what we're seeing now is just a reoccurrence of what happened in 08, 09, because we bought ourselves 12 years of low interest rates. I don't mean just us. I mean all the countries around the world. And here you are, Japan is in its 40th year of their, pushing it, kicking it down the can, and I think it's coming to an end. They've already got negative interest rates. They just announced their package they want to do. Where they're getting this money, I don't know, but it's going to be 20% of their GDP. And Europe's in a similar situation with negative interest rates, heading into a recession, and not knowing how deep that recession is going to be, but nobody knows how they're going to come out of it. So I think we've pushed this thing along, and we haven't used the advantage we got with low interest rates, and now we have to perpetuate it just to have the ability to pay the service, the interest on the debt we've accumulated, not just us, the whole world. If the capital markets were ever allowed to be able to price risk, especially now the sovereign credit risk, this would be unbelievably different scenario. So it's in the background. It's going to happen at some point. We just don't know when. And I'm not so sure how long we can kick it. Nobody knows. But, it's out there, and we'll deal with it when it comes.
Mr. Mariacher, let's switch to you. One of the things you've been looking for is talking about trying to find a bottoming to the market, or at least a bottoming process, was insider buying. And maybe you could just explain to our listeners what that means and what you're seeing out there with that.
Mike, I think that's a great signal. We talked last week about, and previous to that, 3 or 4 days previous to that as well, about Dell. Michael Dell, I think anybody that follows the markets knows of him. He started to buy his own stock at about $32, $33. And when you go back, Michael Dell, I followed him very closely from Dell Computer. He took it private. Then he bought EMC. Then he bought a controlling stake in VMware. He built this company up, and then he brought it back public. And he's a brilliant guy, and he's brilliant in technology. So I watched his interview last night, and he was very aware of everything that was going on. So I thought that was significant that he stepped up. Now, these people are billionaires, but it still shows faith in their own company and possibly, an early stage of whatever we're going to, a bottoming and or possibly, I'll just stay with a bottoming phase. But we'll leave it at that with Michael Dell buying his own stock.
But it was important for you to see that, to at least to give you some faith that we might be in some of that buying process. Mr. Neiman, let's switch to you. I know you're in charge of many portfolios, and one of the things you've talked about a lot is rebalancing, and the market has been just crazy volatile. Has that triggered rebalancing in some of the portfolios? I mean, many of the people on this call are financial guys' clients, and Independent Solutions being in our investment arm. Everyone on this call is part of that team to help them. Has this volatility triggered rebalancing, and if so, how often? And do you see another rebalance in the near future?
Yeah, sure. Thanks. Thanks everyone for participating, obviously, and thanks for hosting, Mike. But I think you pointed out to us earlier today, actually, after you did a client review, that we did a rebalance of our models, our strategic allocation models, which are both mutual fund models, and we also have ETF models. We pulled a rebalance back in the middle of January. The market wasn't quite at a all-time high, but it was pretty darn close. And then we did another rebalance back in the middle of March. And again, the market didn't hit a complete bottom, it looks like, until about March 22nd, 23rd. So we couldn't time the thing exactly right. But if you look back to middle of March to now, we're up, 8-10% on the S&P 500. And so whether we're back, whether that was a true bottom, or we're going to experience maybe another bottom or test those lows here shortly as earnings come out, and the Fed stimulus package continues to grow. They keep adding more and more money, as you talked about, to the stimulus package. And we certainly aren't toward the end of this virus contagion yet. I mean, there's still a whole month left of April that the president said we're all going to sit on the sidelines here. I think it's going to go longer than that. I think the entry points back into society are going to be tough. And how do we get back to where we were 2 months ago with living our lives? But as far as rebalancing goes, there's going to be more of that ahead in our strategic allocation models, even in our stock models. I know all the guys in this call that are managing individual stock portfolios, we're all doing our job to, mitigate the risk in the portfolio, either, sell some positions, buy new positions at opportunistic moments. And really, I think when it comes to rebalancing, we're going to, if we see a point where, say, the market does sort of top off, whether that be today, tomorrow, the next day, a few weeks from now, and potentially go back down. Maybe we do another rebalance to capture some of those profits. But really, we're looking at a long-term time horizon. Little fluctuations in the market for most of our clients are understandable. I think when we look at big fluctuations like what we experienced from the middle of February to the middle of March, there's a chance there to capture, sell at the top, buy at the bottom, or best we can, and really put cash to work and move money inside that allocation model from areas that have gone up, sell high, buy low, and hopefully in the long term that helps our performance and also lowers our risk of the portfolio and really smooth out the ride for our clients.
Perfect. Let's switch to Mr. Meeks here. Paul, I see you, CNBC once a week, twice a week, and of course, they're always asking you tech questions because you were known as the tech guru in the 90s, but I'm not going to ask you a tech question. I'm going to ask you, are there certain sectors that are giving you hope that we may see a light at the end of this tunnel? That's number one. And number two, I keep hearing from all the gurus out there that we have to retest the lows to move forward. And I'm just asking, do you believe in that?
So the first thing first, I would say we need to see a bottom and some hope for the cyclical sectors in the market. The S&P 500 or any economy in any world is divided up into 11 sectors. So the cyclicals include financials, materials, industrials, and energy. And I don't necessarily need to see energy come back in a big way because not only are we seeing a reduction in oil demand because of the coronavirus, but we have this squirrely issue with supply between the Russians and the Saudis. So that is a geopolitical variable that is beyond us. But if you see a bottoming, Mike, in some of those other cyclical sectors, that's a pretty good sign. I'm torn on the second question about are we going to retest the lows. If you take a look at recessions that followed other periods in U.S. stock market history, typically in the bear leg, you have within the bear leg, you have a retracement. So you have a couple of good weeks, and then you forget all that, you drop back down, you retest the lows, and you might even go lower. So if the market troughed on March 23, since then we've had a skyrocket, a very quick bull market in 2 weeks, which is shocking. Usually these things take a year or more. If I was to bet, I probably would say, I don't know if we go back to the March 23 low, but I think that we've come too far, too fast on this snapback rally, so I don't trust this snapback rally. So I'll leave it at that. I think we're going to come back. Do we go all the way back down to March 23? I hope not.
Mm-hmm. Perfect. John, let me ask you, Mr. Thur, out of the committee, you've been really the most cautious, I guess I'd say. What would make you feel confident that a stock market has put in a bottom? I mean, it's funny because I call you the most cautious, but I think long-term you've been the most optimistic, saying, look, we all know that at some point these are great companies and we got to, and I think you and Paul have both been saying this, we need to swap. We need to look for the best companies out there that are on sale. But, what would make you turn confident that, we got a market bottom and we're going to move forward from this?
I'm glad you asked that, Mike, because I know a lot of the times I come on, I point out all the risks in the market. I am a risk-based manager, and for me, it's all about price. It's not that I'm negative on the market. I'm just maybe negative at certain prices. I think the market was way overvalued in 19, and I was not afraid to say it. And right now, I think when in March, the 19th, I think it was, and the 23rd, I was buying heavily. I felt I was getting fair value then. So, that's kind of where I'm at. I'm a fundamentalist. I look under the covers. I kick the tires. I look at the balance sheets, income statements, cash flows. I look at what's practical, and I'm buying into a company that I'm going to own. And if I'm going to be part owner, I want something that's going to be successful, and I want to make money. So my views are more fundamentalist, more am I paying 70 cents for a dollar's worth of value? So I like to steal things. I think when you make good buys and you pay the right prices, you do well in the long run. You minimize your downside, and then you maximize your upside, and it gives you more flexibility, at all times in dealing with this. and not worrying when the market rolls over like it did now that, oh my God, I own all this overpriced stuff and I'm getting crushed. So that's how I look at it. So when the market goes back down again, and it will, I'll be a buyer again. When stocks hit my price levels, and I have limit orders in at where I think I know I'm willing to buy, I can always adjust those, and it all based on the data as it comes out. And there's a lot more data to come out in the next month or two. And we have all talked about all the variables with regard to from getting back to work and getting the economy going to how deep will the recession be to many other questions about the economic data and the amount of money the Fed's going to throw at this and all different things going on. So you got to constantly be evaluating all these factors and then come up with a level at which you're comfortable with owning stocks.
John, if I could just jump in here with the question, Mike, you mentioned, swapping here at the bottom and you're talking about valuations. We're getting some questions into the office about, certain stocks that have just been really beaten up. Can you explain the difference to our listeners between value shopping for good quality companies and bottom fishing? John?
Sure. There's groups of people that like to buy highly volatile stocks when they're down. And what you're seeing now is some of this, move upward. Some of the best performing stocks are the cruise line stocks. Think about that. They've probably got the longest road to come back of any of the companies that have been beat up in here. Yet they're the ones bouncing back the most because they were hit the hardest. So you get some bottom fishers, you get some buyers, and then you'll get some shorts to come in and take them out, and it'll move back and forth. What I try to do is I look for value. I may find a company that has, very little debt on its balance sheet, very high cash position, a very good flexibility with which to run their business going forward. I know they're going to be in business. I know they can not only pay their dividend, but add to that dividend even in a difficult time. And I would be more than happy to buy one of those stocks that isn't a bargain basement because it got crushed, but it's going to be a great stock going forward. The upside's a little less, the downside's a lot less. So I play in a more narrower band of upside downside, and I try to minimize the volatility in the portfolio.
Perfect. Mr. Mariacher, the Saudis, Russians, they reached a deal on deep oil cuts this week. And how big is that for us? How big is it? Why is it big? And why is the market reacting positively to cuts in oil supplies?
The oil and gas industry hit the wall about 5 years ago, and it still got lead feet. And I think John and I were talking about this. I just think that we have found, and we've been too successful finding gas and oil. And overseas, it's always been there. So, but I do think that it's any stability that we can find anywhere, which is all over the world, is good. And I'm not an oil expert, although I've followed them for quite a while. We talked about Chevron 4 or 5 years ago. When it was at $60, Glenn and I were talking about it, and I did buy it for my customers in the high 60s. It got all the way to 120. I, for the most part, still hold it, and it's paid the dividend throughout. It got down, I think, to around $58 or $60. It's back to 80. So you want to talk about volatility, but that brought it. But I'm very skeptical of that industry. I'd rather talk about other industries. I'm not bullish on the industry, and it's I hope it does come out. But
perfect.
Very cautious on it.
Perfect. Mr. Neiman, you buy a lot of dividend stocks in one of your portfolios. Are you seeing those dividends change at all? I mean, earnings all over the place and, all the economic news. Some of the bellwether stuff out there, are you seeing the earnings or the dividends go up or change, or, what's happening with those types of stocks?
Well, we've seen yields go up, obviously, with prices go down. I think we're going to look at earnings and look at, company guidance on certain companies. I'm guessing will lower dividends or have to withhold paying dividends. But my guess is most of the, bellwether blue chip companies that have been paying dividends and raising dividends for years will continue to do so. Some of the things John's talked about, which I've, kind of learned from John because he's been around for, I don't want to say forever because I might hurt John's feelings, but John's been around for a long time, and one of the things he's talked about for the past year or two even is, cash on the books, balance sheets, and making sure we're buying companies that have cash and not, large amounts of debt, or been funding buybacks with debt and those types of things. So been paying quite a bit of attention to what he says and what our companies inside these dividend stock portfolios are doing to make sure we're not buying companies with large amounts of debt on the books so that they can pay the dividends going forward. So I think over the next couple of weeks, we'll see what's happening with dividends and earnings and see where companies lie going forward. My hope is that most companies that are blue chips that have been paying dividends for years will keep paying them, because that's how they're going to keep their share price up. If they go ahead and lower dividends or they say they're not going to pay a dividend for a quarter or two, that's going to drop stocks considerably, especially these large cap dividend paying stocks. So not fearful of that happening. I think that most companies will survive it and continue to pay the dividends, at least the ones that we own.
Perfect. We'll get down a few more questions here, and I'll let everybody go. Mr. Meeks, the market did seem to rally when Sanders dropped out. How much of this is going to be coronavirus versus political? It's funny, we sort of forgot all about the race. It's been all about the coronavirus over the last 3 weeks. But, the market did respond positively when Sanders dropped out.
Yeah, I think that for the time being, until we get much closer to the actual general election, that it's 24/7 radio station, all coronavirus all the time. I think that is a much bigger factor. Of course, without the coronavirus, we would be obsessing over what the two rival political candidates would say every night on the news. But I think the coronavirus is much more serious, much more pressing, and what we need to essentially focus on for not just the next couple of weeks, but probably several months at least.
Perfect. Final thought, Mr. Thur. Any advice for our listeners out there? Again, you've been the most cautious, and I'd really like to see your thoughts on, what you're looking for over the next 7 days.
I think everybody should relax a little bit and be, how should I say, get themselves ready for a little bit longer haul than whatever they hear on the TV or the radio. I think you just be patient, and I'm letting the market come to me, and I'm going to be a buyer at the right prices, and we're going to have some really nice looking portfolios over the next couple of years. But I'm not chasing anything, and I'm not afraid to miss anything. I think there's a lot that needs to play out, and I'm going to let it play out.
Perfect. All right. Well, I think, I'll end with the diversification. That's been our theme all along, and I'm sticking to it, and I believe in it. And I think it will weather us through these types of storms. So we are going to be doing this same call, 4:15 every Thursday, until markets sort of go back to some kind of a normal and the virus starts to go out of our lives. So we do appreciate everyone spending some time with us today. And hopefully you can join us each and every Thursday for an update. If you need more information about our services or our different departments, you can call 833-FIN-GUYS. For financial advisors that are seeking additional information, many financial advisors on this call, looking for information on independent solutions, wealth management, model portfolios, performance data, or our private wealth group, go to iswealthmanagement.com or give us a call at 716-568-8566. We will see everybody next week, and thank you so much, and have a great weekend and a happy Easter.